Hello, everyone, and welcome back to our webinar series for young investors. This is session 3 of 5. I'm Rachel Winter. I'm one of the investment managers here at Killik, and here on the screen we've got my colleague Tim Bennett, who's one of our he's our head of education here at Killik, and he also edits the Killik & Co magazine. So over the course of these 5 sessions, our aim is to help you guys to learn about how to invest. And we're doing that by putting together a virtual portfolio. And over the different sessions, we're following that portfolio and learning about how different stocks have moved and why. So for anyone who missed the first couple of sessions, I'm just going to pop the agenda on the screen to show you what you've missed. So this is what we're planning on running through over the 5 sessions. So in the first one, we just gave a brief introduction about how to invest, and we talked about how we look for investment ideas. And then your homework for that one was to send us lots of ideas about how you think we should be investing. And then in the second session, we talked through all of those ideas, and then we voted on which of those ideas we thought should go into our virtual portfolio. And we decided on 12 companies to put into our virtual portfolio. So today, we're going to have a look at how that portfolio has performed over the last 3 weeks. And I have to say there have been some really big movers inside the portfolio, which I'm actually really pleased about, because I was a bit worried that over the course of these 5 sessions, we wouldn't see any big movements in the market. And that would have been quite hard to learn from. But as it happens, we've had lots of big movements over the last 3 weeks. So we're going to have a lot to talk about today. So as we've done for the first couple of sessions, I'm just going to run through a couple of big things that have happened in the last 3 weeks since our last session. But before I do, let me just remind you of the 12 stocks that we agreed to put in our virtual portfolio. So here they are on the screen. The first one is Alphabet, which is the owner of Google. So it makes a lot of money from search advertising. And it also owns YouTube and lots of other things like Google Maps, Google Docs, Gmail, etc. So a very diverse and a very profitable company. We've then got Amazon. I'm sure all of you know about Amazon. Also owns Twitch, and I know a lot of you were fans of that. Amazon obviously makes a lot of money from its e-commerce, but also it's very big in cloud computing. That accounts for nearly half of Amazon's revenue, and that is the fastest growing part of the business at the moment. We've then got AB InBev, which is the biggest beer company in the world. We've got AstraZeneca, which is a big healthcare company, and it's making one of the coronavirus vaccines at the moment. We've got Beyond Meat, which is making a vegan alternative to meat. We've got IAG, which is the owner of British Airways. We've got Lloyds Banking Group, which is one of the biggest banks in the UK. So it's taking in deposits from savers and it's lending out money to people who want to buy houses or businesses who need to borrow money. And we've then got Newmont Corporation, which is the biggest gold mining company in the world. So this company is literally taking gold out of the ground and selling it on. We've got NIO, which is an electric car company based in China. We've got Northland Power, which is a wind farm developer. We've got Peloton, which is the owner of those electric bikes that you can buy for your home. And then Xylem, which is a water technology company. Over the last few years, largely due to global warming, we have seen an increasing number of adverse weather events, including lots of floods and also drought. And Xylem is a water technology company that can help with both of those things. So, for example, 2 years ago, when we had those big floods in Paris, Xylem was on hand to help pump away that excess water. And at the same time, we had a lot of drought in South Africa, particularly in Cape Town, and Xylem is able to desalinate, i.e. take the salt out of seawater so that people do have water to drink. So we've got a really diverse range of companies in our portfolio. So that's the 12 that we're looking at. And now I'm going to move on to have a look at some things that have happened in the markets since the last session. So one of the things we've really seen over the last year is a weakening of the dollar and a strengthening of the pound. So this chart shows the two currencies over the last year. And as it goes down, that means the dollar's weakening and the pound is strengthening. But you can see at the very start of this chart, so if we go back to March when the coronavirus really became a big thing, there was actually a big spike upwards in the value of the dollar. And that's because the dollar is seen as a safe haven currency and the pound is seen as a bit risky. So when people were worried about the coronavirus, when it was quite new and they didn't really know what it was, people sold pounds and they piled into dollars. So we really saw the value of the dollar spiking upwards. But since then, the dollar has weakened and the pound has strengthened. And that's been helped by things like Brexit. We've got a bit more clarity now over what's happening with Brexit. That's been good for the pound. And more recently, Boris Johnson has published his plan for easing the lockdown in the UK, and that's also been good for the pound. So this strengthening of the pound is good news if you want to go on holiday, But if you're based in the UK and you've bought a stock in the US, that movement in the currency will actually have lost you money. So if you've bought a stock and the share price hasn't moved, but the dollar has weakened, you will have lost money because of that. And a lot of the stocks in our portfolio are based in the US. So over the last 3 weeks, we've lost a bit of money because of that currency move. So that's one thing that's been happening recently. We've also seen a rotation between different sectors of the market, and that's because investors are starting to look ahead to a time when the economy will start to reopen. So if you look at the market sectors on the top of the slide here, we've got energy, so that's things like oil and gas, materials, that's the raw materials used for building, industrials, that's kind of heavy machinery, financials, that's the big banks that are lending money to corporations, and then consumer discretionary, that's things that you buy when you've got excess money. So all of those types of companies along the top, they tend to do really well when the economy is booming and there's lots of money sloshing around. The companies on the bottom, utilities, so that's gas and electric companies, consumer staples, and that's companies making things like toothpaste and deodorant, healthcare, telecoms, i.e. your phone bill, those companies tend to be much more stable and we call them defensive. So over the last few months, because people have been worried about the economy, these defensive, safer companies have been more popular. But now that we're thinking ahead to a time when the economy might start to grow and open again, investors have been moving out of those defensive companies and moving into these riskier companies. And that has caused a bit of a movement within our portfolio. And just to kind of put this into context, if you imagine that a consumer discretionary item would be something like an iPhone or a pair of Nike trainers, whereas a consumer staple would be something like toothpaste. If you're struggling for money, if you haven't got a job at the moment, you'd probably still buy your toothpaste, but you wouldn't be buying things like iPhones or Nike trainers. On the other hand, if you do really well, if you get a great bonus from your job, you're not going to buy any more toothpaste. You're probably going to buy more iPhones and Nike trainers. So when people have more money, those companies on the top row, those consumer discretionary companies, are the ones that become more profitable. And the final thing that's happened since our last catch up, the UK has arranged a leasing for a number of offshore wind sites. So if you imagine that you're a company that wants to develop wind farms, the first thing you have to do is get a patch of land to build your wind farm on. Now, one of the most popular ways to build a wind farm at the moment is to build them offshore in the sea, because you can build much bigger wind turbines. And there aren't many places around the UK where you can actually build a wind farm. And it's quite rare for the UK to auction off these bits of sea to allow companies to build these wind farms in them. But last week we did have one of these auctions, and the UK auctioned off 6 different areas around the UK so that companies could build wind farms on them. But what happened was that so many companies wanted access to these bits of sea that the prices they paid for them were just astronomically high. So even companies like BP, which is an oil company, that was trying to get out on the act because it's trying to move away from oils and become more of a renewable energy company. And the prices paid for some of these bits of sea was so high that there's now a concern that it will be very difficult for some of these new wind farms to actually make money. So because of that, we've actually seen a sell-off in lots of wind farm developer shares over the last week or so. And this is the reason why that has happened. So that's the 3 big things that have been happening in the market since our last session. And now I'm going to move on to Tim, who's going to talk you through some different financial ratios and talk you through how we would actually value the companies that we're investing in. So Tim, over to you.
Yeah, thank you very much, Rachel. Great to be back in front of you. And what I'm going to do is loosely describe what equity analysts do. And I've only got 10 minutes to do it, so it's going to be a bit of a challenge. But essentially, when you're looking at the market and looking at what's going to happen next and should I buy or sell a stock, is it a good idea or not? Essentially, there are 2 basic approaches you can take. One is top down, which is known as charting following the crowd, if you like. This many people can't be wrong. The trend is your friend. And in a way, you're just looking at what seems to be happening to a particular stock or an index to get a feel for whether you should buy or sell. Then there's bottom-up investing, which is rolling your sleeves up, looking at individual companies from the ground up and making an investment case, almost standing apart from everyone else and thinking, what do I think? Do I think this is a good company? Do I think it's good value? So I want to take those in turn. What is the top-down approach, the momentum-based approach, if you like? The trend is your friend. Well, imagine for a moment, if you will, I'm just going to bring in a prop here. Imagine you were trying to work out what was happening to a share. What you could do is calculate a thing called a moving average. Now, if you bear with me on this primitive whiteboard, what this shows is a share price over 3 days. Really simple share price, closing price for a company, £1, £2, £3. Now, it doesn't take a rocket scientist to realize the average, the simple average is 2. Now, were you to move on a day, drop the day 1 reading and bring in another day, so 2, 3, 4 are your 3 readings, you'd say the moving average has now moved up to 3. That's just the simple average, the mean of those numbers. If you had readings of, as you can see there, 3, 4, 5, the moving average moves up again. And that moving average is just a 3-day moving average. So it's just using 3 data points. So as such, you might say, well, it's not terribly representative. It could be skewed by big stock movements in an individual trading session, but nonetheless, it would give you a flavor for what's happening to the stock price over those 3 days. And if you plotted that on a chart, you'd have the overall share price movement. Now, 3 days is not a fantastic moving average. What you might want to do is to use a moving average for more like 50 days or 200 days. And this would be a short-term moving average. This will be a longer-term moving average. And what people are doing, imagine this on a chart, is they're saying, well, if the short-term average is moving up through the long-term average, that's quite bullish. Equally, if the short-term is moving down through the long-term, that's quite bearish. And if long-term a share is moving up, but this cuts through it, that could be a sign that things are heading down. Maybe that's downward pressure on the share price. And equally, if you've got a company that's basically moving down on this average and you've got this coming up through it, that'll be quite bullish. So people watch what's happening to the short-term moving average versus the longer-term moving average and take that as an indication that they should either buy, ideally ahead of everyone else, or sell, ideally ahead of everyone else. And you get some quite glamorous names given to these things. So when this short-term average on a chart, rather than on post-its, moves up through the longer-term moving average, that can be known as a golden cross. That can be very bullish momentum. Now, there are people saying, well, that's all very well, but all you're doing there is reading lines on a chart or little post-it notes in my example. So isn't that just sort of relying on the market to get things right? It all seems a bit sort of vague and fluffy. So bottom-up analysis or value investing says, no, I'm not going to do that. I might nod to that. I might use that to help me. I might try and read the charts, if you like, a little bit. But fundamentally, what I'm going to do is bottom-up analysis. I'm going to take a company and I'm going to start from the bottom up and make the case for buying it. And what you might do is look at some fluffy stuff, hence the clouds, which is quite difficult to put a number on. So the quality of the management team. This is not worrying about what the share price chart is doing. It's actually looking at the individual company. You might look at the strength of the company's moat, as Warren Buffett called it. Does it have competitive advantage? How easily can competitors get into this share of the market? Are there regulatory protections, for example? Is it quick to scale up a business in this space or quite slow? How loyal are consumers and how quickly could a competitor drag them away? That's called stickiness. But that's all quite fluffy. Allied with that, you might then want to do some number crunching on the company, both its financial strength, looking at the balance sheet, its assets, and so on. And also what I'm going to touch on here, which is value for money. Do I want to buy this company? Forget what the rest of the market's thinking. Do I think it's good value? And there are a couple of ratios you can use to help you with that, which I'll come to in a moment. But essentially, what bottom-up value investors are doing is comparing two things. They're saying, let's look at the market value of the company and compare it to what I think it's actually worth. And essentially, if the market's up here, but what I think it's worth is down here, well, maybe the market's priced that a bit expensively, so I need to really think that's a good company. But if maybe we're looking at an intrinsic value like that, then maybe the market's got it wrong. Maybe I'm seeing something, doing my number crunching at home, that the market isn't. So maybe there's an opportunity there. Now, what would I be doing? I mean, what would I be looking at? Well, lots and lots of numbers potentially, but two that get quoted in the press, probably more often than any other, are these two, the PE ratio and the dividend yield. Now, to take those in turn, the PE ratio asks a very simple question. It says, if you buy the share at today's share price, how many times 1 year's earnings is that? So you get a number like 10. Share price is £10. Earnings per share forecast for the next year is, let's say, £1. Okay, that will give you a PE ratio of 10 times. Crudely speaking, a PE ratio of 10 times, ignoring discounting, basically says, if I bought the share at today's price, I'd be prepared to wait 10 years to get my money back in earnings terms. And you might think, well, I would wait 10 years for something, but then how come some technology stocks have got PE ratios of 100? Who waits 100 years to get their money back? The answer is not many investors I know. So a high PE ratio suggests investors are expecting rapid growth in earnings. They're looking to the future. They don't know what the future holds. And they're saying, no, I think this company is going to grow fast. So I am prepared to pay quite a significant premium to get hold of it today, because actually it's not that much of a premium when you look at the company's future growth prospects. But there are other investors who say, no, I'm not interested in those high PE growth stocks. I want solid companies, perhaps with very low PE ratios. So utility companies might have a PE ratio of, say, single digits. I mean, the UK stock market, as the FTSE 100, hovers around, let's say, 12, 13, 14, 15. So there might be companies out there trading on only 8 or 9 times 1 year's earnings. Why are people buying that? I mean, that doesn't sound very exciting. Not a growth company. Or maybe you're looking at a company that's offering a decent dividend yield. So out there, you've got investors looking for growth, investors looking for income, and you've got investors looking for a mix of the two in an ideal world. And there's a trade-off. If you want growth, high PE ratios, chances are you're not going to get much of a dividend out of the company because it's using all its money to grow. But equally, there are companies that don't grow very fast, but do offer decent yields. Now, what's the yield? This is saying if you're an income investor, the company has the option to pay some of its profits back to you every year rather than keeping them to grow. So you could look at what the company pays out as an annual dividend, put it over the current share price, work out a percentage, and that will give you a dividend yield. So this is a number, this is a percentage. And there is a trade-off, generally speaking, insofar as if you want growth, you're not going to tend to get yield. If you want yield, you're not going to tend to get growth. All right. Now, as a bottom-up investor, therefore, you need to decide, what am I after? Am I looking at this company as a source of income? Am I looking at it as a source of growth? And then these are just two of the numbers that start to get you into, is this good value for money or not? All right. In other words, what level of growth am I going to get in the future? And that requires a little bit of crystal balling, if you like, predicting earnings, which is not easy to do, versus how much cash might the company pay back in the future, jam today rather than jam tomorrow. At that point, I'm going to leave you with those thoughts, top down, bottom up. Most equity analysts use a mixture of the two. The balance will depend on the analyst you talk to. But for now, I'm going to hand back to Rachel.
Great, thank you, Tim. Let's get these slides up again. So as Tim said, price to earnings ratio and also dividend yield are two things that we would always look at for a company. Some other things that I might look at are simply how big is the company. So we would look at something called market capitalization. And this is simply the number of shares that a company has times by the current share price. And it just gives you an idea of how much the stock market thinks this particular company is worth. Generally, you find that very, very large companies are perhaps less likely to grow because the fact that they're so large suggests that they're quite established already, whereas a very, very tiny company could potentially have a bit more growth ahead of it. But that's not always true. So have a look at these examples on the slide here. We can see that Amazon, currently one of the biggest companies in the world, it's worth over $1.6 trillion. It's absolutely massive. And yet it's still growing. So it's really impressive to have achieved such a large size, but still such a high rate of growth as well. So Amazon is a very impressive company. Same for Alphabet, the owner of Google. It's also a very, very large company. It's worth $1.4 trillion, and yet it's also still growing very quickly. Got a couple of smaller companies here. Tesco, I mean, it does trade in the UK, but if we converted the value to dollars, it would only be worth about $24.8 billion. It's one of the largest companies in the UK, but look how small it is compared to these massive American tech stocks. And then just to put it in context, we've got IAG, which is the owner of British Airways. That's only worth about £9.35 billion. So very, very small in comparison to Alphabet and Amazon at the moment. I would also consider what sector the company is in. So we talked a bit about this earlier. So I would have a think when you're buying a share about what sector it's in, and therefore how likely it is to perform at different stages of the economic cycle. And often you'll find that some companies might fit into more than one category. So for example, Amazon, I mean, is it a technology company because it offers that cloud computing? Or is it consumer discretionary because it's offering us things that we want to buy? So often you might find that some companies will fit into more than one category, but it's always worth having a think about what sector a company fits in before you start investing in it. Now, last week we had a look at Yahoo Finance. I think this is a really good way just to keep an eye on a list of stocks. It's really easy to just to look up a stock on here and get a feel for some of these ratios that Tim was talking about. So let's have a look at a couple of examples of companies and let's see how they look on Yahoo Finance. So the first one here is Amazon. So you can see on the left-hand side, obviously you've got the company name, you've got a chart showing you what the shares have done over the last year. You can change that time period if you want to. You can see in the large print what the current share price is and what it's done over the last year. And then on the right-hand side, you can see we've got some of those ratios that Tim was talking about. And you've got a couple of other things here as well. So previous close, that's simply the share price that was closed out on the market day prior. Opening price is where did the share price open when the market opened on this particular day. Low and high are simply the highest and lowest prices that have been achieved on this particular trading day so far. 52-week high and 52-week low, that's simply how high and low the share price has been over the last year. Market cap, as we've just mentioned, that's the current share price multiplied by the number of shares in existence. So it's a way of working out the value of the company. Volume, simply the number of shares that have changed hands on this particular trading day. And then the price to earnings ratio that Tim mentioned. So for Amazon, this is 75.07 times, and that's considered to be a pretty high price to earnings ratio. Historically, we would have considered a ratio of about 15 to be fairly normal. So 75 really is quite high, and it is showing you that investors really expect a high level of growth from Amazon. And we've then got earnings. That's simply the date that we're expecting Amazon to publish its next set of results. Dividend, Amazon doesn't actually pay one. Rather than paying out its profits to shareholders, it simply rolls them back into the business and uses that money to help it expand even more quickly. And finally, one that I've missed, beta is a way of measuring how sensitive a share price is in comparison to the rest of the market. So if you've got a share with a beta of 1, if the market goes up by 10%, that share would be likely to also go up by 10%. If it had a beta of half, if the market went up by 10%, you would only expect your share to go up by 5%. On the other hand, if it had a beta of more than the market, if the market went up by a certain amount, if it had a beta of more than 1, if the market went up by 10%, then your particular share would be likely to go up by more than 10%. And that's what we're seeing here with Amazon. So having a beta of 1.14 suggests that Amazon is quite a volatile stock. Let's move on and have a look at the company on the right-hand side. So this is Newmont. This is the biggest gold mining company in the world. So you can see it's $56.52 per share at the moment. If we compare it to Amazon, the market cap of Newmont is, I say only, $45 billion is still a huge amount of money. It's still a very big company, but it's pretty small in comparison to Amazon. Price to earnings ratio is only 16, so it's much, much cheaper than Amazon in that regard. And the beta is only 0.25. So that suggests that this is a company that really isn't that volatile. It's a share that would be likely to be much more stable if you're looking at historically how the share price has performed. So that's a few ratios that we would tend to look at on Yahoo Finance there. Now let's move on and have a look at how our portfolio has performed over the last 3 weeks. And as I said, we have had some really big movers in the portfolio. So here's the list of stocks. And on the right-hand side, you can see how they've moved. Unfortunately, there's quite a lot of red on the screen. So you can see that a lot of our stocks have fallen in value over the last 3 weeks. The two at the top have actually done very well. So IAG, that's the company that owns British Airways. Since the government announced its plans for easing the lockdown in the UK, we've seen loads of people rushing to book holidays. And that's been really good for the airlines. And therefore, we've seen a big rise in the price of airline shares, including IAG. Lloyds Banking Group is very exposed to the UK economy. So if the UK economy is growing, that tends to be good for the banking sector. Now that our plan for opening the economy and easing the lockdown has been published, that bodes quite well for the banking sector. And we have seen quite a big rise in banking shares over the last couple of weeks as well. All of the other shares, with the exception of AstraZeneca, are listed in the US. AstraZeneca is listed in the UK, but it earns lots of its profits over in the US. And therefore, all of these shares have been hit by the weakening of the dollar that we've seen recently. So that's one reason why we've lost a bit of money on these particular shares in our portfolio. But what we've also seen is a movement out of stocks that have benefited during lockdown. So, for example, Peloton at the bottom, we've lost nearly 22% on Peloton just in the last 3 weeks. And that's because investors have been moving out of companies like Peloton, which have done really well in lockdown, and they're moving into companies that they expect to do well as lockdown starts to ease. So companies like IAG. And then the other one that I'll highlight is Northland Power. So this is a developer of wind farms. So this has been caught up in this concern about it being really expensive to acquire new leases to build wind farms. So that's the reason why Northland Power is off by about 9% over the last 3 weeks. So those are some of the key movers that we've seen in our portfolio since we set it up 3 weeks ago. And then finally, I'm just going to show you a share price chart that gives you the share prices of 3 of these companies over the last 12 months. And this chart is indexed, so it's just showing us the percentage return in these particular companies over the last 12 months. So the one at the top is Amazon. Then we've got Northland Power, the wind farm developer, in the middle, and then we've got IAG at the bottom. So if we look over the last year, I mean, all of these company shares fell last March when people got worried about the coronavirus. But then people just started to realize that Amazon in particular will actually probably really benefit from lockdown. And people started buying into Amazon shares, and it did really well throughout the first half of 2020. And since then, it's been fairly flat. So it hasn't come down a huge amount, but it's been fairly flat over the last few months. For Northland Power, again, it fell in March when the whole market fell. But over the course of the last year, it's broadly been a very steady performer. It's just been rising very steadily. But then in the last 2 weeks, since the results of that wind farm auction were published, you have seen the shares come off quite heavily. So there's a real drop off in the shares of Northland shares at the end of the chart there. And then finally, we've got IAG, owner of British Airways. You can see last March, when we went into lockdown, there was a huge fall in these shares. They dropped by more than 50%. They carried on falling. And if we look at September, October time, these shares are down by 75% compared to where they were last February. So really heavy losses for this company. But you can see that as the economy has started to open again, these shares have started to recover. And investors clearly think that that will continue because they have been buying the shares this week. So that's just a quick summary of some of the movements we've seen in our portfolio over the last 3 weeks and what we expect to happen to those shares over the coming weeks. So I'm going to finish there and make time for some questions. There's quite a lot to look at there, so I'm going to give you 30 seconds or a minute or so just to think about some questions, have a think about what you want to ask, pop those questions in the chat, and then in a couple of minutes' time, we'll start to have a look at some of those questions and answer them for you. Okay, so we've got a couple of questions coming in. So the first one is probably a good one for you, Tim. The first question is, how does volume affect the share price?
Yeah, very good question. Volume is an important factor. How it affects the share price, it depends. If you've got very low liquidity stocks, which to translate that into English means relatively low trading volumes. And this is information that's available in publicly traded securities in particular on a sort of daily basis. But very low volume shares, less popular, less liquid, a lot of interest can suddenly move the price quite quickly. So if you suddenly get a rush of buyers or a rush of sellers, that can cause the price to either spike or drop quite sharply. Whereas if you've got a much more liquid security, let's say a FTSE 100 company, it takes a lot more volume on either side, buying or selling, to move the price. In terms of a sort of trading signal, as such, yes, people do watch volumes, because volume can be the canary in the mine shaft, if you like. It can be, if volumes are starting to drop away in a relatively popular security, it can be a sort of heads up that momentum is starting to drift behind, say, buying activity. And equally, if stock is already drifting and you suddenly see volume start to pick up, they may not be enough by themselves to move the price. It's very big liquid stock, but it might be indicative that interest is starting to sort of pick up in that particular security. So it's quite a long way of saying, yes, volume does, daily traded volume, number of bargains, if you like, does matter in terms of the potential price pattern on a security.
Thank you, Tim. And there's one question here which I'll take. So with the lockdown easing, which of the companies in our portfolio do you think will rise the most? Well, I think the best way to look at that is to look at the companies that have already risen since that lockdown easing announcement came out, because investors tend to buy stocks based on what they think will happen in the future, not what's happening right now. So when that announcement came out about the economy opening up in June, lots of investors started buying companies that they thought would benefit from that lockdown easing. So the companies that came up the most were IAG and Lloyds. And therefore, that shows you that investors expect those companies to perform the best. So I would expect that trend to continue for the foreseeable future. Tim, another good one here for you. What do you think of the future of blockchain technologies?
How long have I got? No, great question. I mean, my short answer, has to be a short answer, is it's a very good question. You need to disentangle two things. There's blockchain technology, which I think is incredibly exciting. I think has applications well beyond where people tend to see it, which is manifesting in Bitcoin, in cryptocurrencies. And I think those are the two things to disentangle. Yes, cryptocurrencies are a manifestation, almost evidence of the fact blockchain technology exists, but actually its application in document storage, in all sorts of areas that have nothing to do with Bitcoin and the like, is where it's really exciting. And I think, yes, we're going to see more and more blockchain technology underpinning things which in the past, we've taken for granted. As for whether there's a hidden question there, very different to saying what's my view about Bitcoin and so on. Frankly, I don't know how to value it. I'm not alone in that. And therefore, would I invest in it other than purely speculatively like I would on a football match of the horses, which I don't do, obviously, by the way? No, I wouldn't. Because if I can't value something, and there is another question in the inbox which links to this, for me, it's not something I can invest in. But yes, blockchain, the technology that underpins that stuff is definitely exciting.
Yeah, and we get so many questions about it from clients, but at the moment, there's not really a company on the stock exchange that just does blockchain. So often we find there are things we want to invest in, but we can't at the moment, but it's something we're definitely looking at. Another question which I'll take. Why do you think the share prices have gone down for a lot of the stocks that we're following? In some cases, it's actually not that the share price has come down. It's in some cases, the share price has stayed fairly constant, but we've lost money because the currency has moved. So that's the case in some situations. I'd also say that many of the stocks that we've bought have done really well over the last year, and therefore lots of other investors will have made quite big profits. And now they're taking advantage of the opportunity to sell out of those stocks, take those profits, and move into something like an airline, a travel company that they expect to have a bit of a bounce when lockdown starts to ease. So I think those are the main reasons, but it's only been 3 weeks. for investing, you know, we want to look at much longer time horizons. So it could be that when we come back and look at these again in 3 weeks' time, our stocks could be up. It's just a case of, it's just something about investing that it can be very volatile. So this is why the virtual portfolio is good, because you're not losing real money. One here for you, Tim. Is top-down investment a form of extrapolation?
Yes, it is, in a way. Basically, charting, and I have quite a few videos out there free to watch on YouTube about some of these things. But yes, essentially, it is a form of extrapolation. What people are essentially doing, the trend is your friend, I mentioned, is a cliche, if you like, but it's a good one, because it's essentially saying that there are analysts out there who try to anticipate movements in asset prices and share prices. They don't look too much at value. They're just saying, where's the money going? Where does it seem the momentum is? And they try and get in as early as possible. And to get in early, what you need to do is try and forecast certain patterns that have been seen in the past repeating. It's this idea that history doesn't exactly repeat itself, but it does rhyme, as Mark Twain put it. So there are patterns, gloriously named head and shoulders, for example, which almost looks like on a chart what you think it looks like. And analysts look to see whether that's forming and then try and trade ahead of it, thinking, well, if that completes, I know I'm going to make some money. Now, nobody knows for sure they're ever going to make some money in the stock market. But yes, it is based on, if you like, looking into the future. But then so is a PE ratio done using forward earnings. So anyone looking to take a position in a stock or an index is always looking ahead by one means or another.
Great. So another question, we can probably answer a bit of this each, Tim. And so the question is, how can you use all the ratios to determine if a company is over, under, or fairly valued? Difficult question, because I would say that most financial analysts have their own favorite ratios and favorite ways of using them. So I do like to look at the price to earnings ratio. So I suppose you've got to think to yourself, what price to earnings ratio are you personally happy with? Do you have a figure in mind that you're looking to work towards? Do you want to compare your company to the average price to earnings ratio for companies across the rest of the market? Or do you have something else that you're working to? So it's really a very difficult question that does have a bit of personal preference involved. Tim, I don't know if you want to add to that.
Yeah, I mean, I can add a couple of things there briefly, building on that ratio, the number, identify what the key driver for a business is, because that will influence to a degree what ratio you think is useful to decide whether it's cheap or expensive. So what do I mean by that? You know, is earnings the driver of value for shareholders? For an awful lot of companies and sectors it is, so PE ratios come into play. But if you're looking at a company that's driven by the size of its book, as it's called, it's sort of, you know, the asset side of the business, perhaps you're looking at investment companies, perhaps you're looking at property investment companies, then things called the price to book ratio, which is this cheap or expensive as a multiple of its book. If you don't have any earnings, analysts will look at price to sales, because they'll say, well, the company isn't earning it, it's young, it's growing. I can't do a PE ratio because there's no meaningful number there, it hasn't got any earnings. So they'll look at the price to book ratio, the price to sales ratio, on the basis that sales is a pretty key number. And you know, then if they're stuck again, you do get companies out there with no balance sheet to speak of, no earnings, no positive cash flow, and they might not even sold anything yet, in which case you get into the heady world, as I see it, of price to what? Eyeballs, clicks per page, who knows? But whatever metric you use, one is dangerous, I think. The PE ratio and the dividend yield are a very useful starting point. What you're trying to do is build a picture, build a pattern. So I would do as many ratios as I think are sensible to do on a particular company. And my choice might vary slightly. I think Rachel would agree with that. And try and build a consistent picture, because you might get an outlier on one measure. So you're trying to look for a pattern, and ideally across several time periods, not just one.
Yeah, absolutely. I mean, there are dozens and dozens of different ratios, so we didn't want to bombard you with loads of different ones today, but there are probably a few more that we can touch on over the next couple of sessions.
For sure.
Next question. Will our stocks in USD keep going down if the value of USD keeps falling? So there's probably two ways of looking at this. So if the share prices themselves don't move, but the dollar keeps weakening, then we will lose money because we're based in the UK and we're valuing our portfolio in pounds. On the other hand, if the dollar weakens quite a lot, and if you've got a company that's based in the US and it's selling goods outside of the US, then a weaker dollar makes the products or the services that that company is selling look cheaper. And therefore, it could end up selling more because of the weak dollar. So actually, the company could then become more profitable. And over time, that could reflect in the share price, and the share price might come up. So difficult question to answer. Currencies are a really difficult one. So when we're putting a portfolio together, we try not to take a view on where we think a particular currency is going because that's so difficult to predict. Instead, we just try and have a range of different companies from a range of different countries inside our portfolio. Great, so I think that's it then. So thank you so much to everyone for turning up again, and we look forward to seeing you in session 4.
Absolutely.